Top 5 most powerful price action candlestick patterns every trader must know. By mastering these patterns, even novice traders can boost their profitability in the market. Did you know that these 5 candlestick price action patterns are remarkably easy to learn and comprehend? So, without further ado, here are the 5 most powerful candlestick price action patterns that you must know. I will rank from great price action candlestick patterns to the very greatest and most sought after by big trader. 5th. Morning Star and Evening Star. The Morning Star and Evening Star patterns serve as important signals for professional traders, akin to green lights, signaling potential profit opportunities in the Forex and stock markets. These patterns are quite popular because their appearance is often followed by longer corrections compared to other patterns. The Morning Star indicates a bullish reversal, while the Evening Star suggests a bearish reversal. Traders keen on maximizing their gains pay close attention to these patterns as they provide valuable insights into potential market movements. The Morning Star pattern can be identified based on the following characteristics. First, the first candlestick is bearish, indicating a part of a downtrend. Second, the second candlestick is smaller in body size and can be either bullish or bearish. This reflects market indecision. Third, the third candlestick is a bullish candlestick that is longer than the second one. Its length doesn't necessarily have to match the first candlestick, but its closing price should exceed halfway into the body of the first candlestick. This confirms the formation of the Morning Star pattern. Here are the characteristics of the Evening Star pattern. First, the first candlestick is bullish, indicating a part of an uptrend. Second, the second candlestick is smaller in body size, whether bullish or bearish. Third, the third candlestick is a bearish candlestick that is longer than the second one. Its length doesn't necessarily have to match the first candlestick, but its closing price should exceed halfway into the body of the first candlestick. This confirms the formation of the Evening Star pattern. At times, both candlesticks may form a doji, leading to the modification of the pattern's name to Morning Doji Star or Evening Doji Star. Trading with the Morning Star candle pattern involves several steps. Firstly, it's important to ensure that the selected trading instrument is in a downtrend, indicating potential selling pressure. Next, traders wait for the Morning Star pattern to form perfectly before considering entry into the trade. To confirm a buy entry, traders draw a trend line from the opening of the first candlestick and patiently wait for the next candlestick to break out above the first candlestick. This breakout signals a potential reversal from the downtrend to an uptrend. The focal point of the Morning Star pattern often involves the presence of a doji candle. When this doji candle forms below the bearish candle, it suggests a weakening of bearish momentum and hints at a forthcoming bullish reversal. Further confirmation points are observed in the characteristics of the third candlestick. A longer body compared to the first candle indicates a strong indication of the potential upward reversal. Finally, once the next candlestick closes, traders can confidently enter a buy position, while placing a stop loss below the low of the Morning Star candle, to manage risk effectively. This systematic approach assists traders in identifying and capitalizing on potential buying opportunities with confidence in the market. Trading with the Evening Star candle pattern involves the following steps. Firstly, it's crucial to confirm that the selected trading instrument is in an uptrend or experiencing rising prices. Once this is established, the trader looks for the Evening Star candle pattern. The Evening Star pattern consists of 3 candlesticks. The first candlestick should be bullish, followed by a gap up between the first and second candlesticks. The third candlestick is bearish, confirming the potential reversal. To confirm a sell entry, traders draw a trend line from the opening of the first candlestick and wait for the next candlestick to break out below it. This breakout signals a potential downtrend. The focal point of the Evening Star pattern is often marked by the presence of a doji candle. When this doji candle forms above the bullish candle, it suggests a weakening of bullish momentum, with a possible bearish reversal in the making. Confirmation points are further reinforced by the characteristics of the third candlestick. A longer body compared to the first candle indicates a stronger signal for the impending downward reversal. Finally, once the next candlestick closes, traders can enter a sell position, while placing a stop loss above the high of the Evening Star candle, to manage risk effectively. This comprehensive approach helps traders navigate potential selling opportunities with confidence in the market. Trading with both of these patterns is essentially straightforward. 4th. Dark cloud cover and piercing line. The dark cloud cover and piercing line are two significant candlestick patterns used in technical analysis to signal potential market reversals. Firstly, let's delve into the dark cloud cover pattern. The dark cloud cover is a bearish reversal pattern that typically occurs at the peak of an uptrend. It consists of a large bullish candle, followed by a bearish candle that opens higher than the previous day's close, but closes below the midpoint of the prior bullish candle. This pattern suggests a shift in momentum from bullish to bearish sentiment in the market. It's essential to note the dark cloud cover's significance, especially on higher time frame charts like daily charts, as its reliability diminishes on lower time frames. The criteria for identifying the dark cloud cover pattern include: first, an established bullish uptrend. Second, a bullish candle within that uptrend. Third, a gap up on the following day. Fourth, the gap up transforms into a bearish candle. Fifth, the bearish candle closes below the midpoint of the previous bullish candle. Understanding these criteria helps traders recognize potential opportunities to enter short positions or tighten stop-loss orders to protect profits. Here are the steps for entering a short position using the Bollinger Bands indicator, focusing on the daily chart. First, look for a clear uptrend on the price chart. Second, identify a dark cloud cover formation. Third, check if the second bar within the dark cloud cover is outside the upper Bollinger Band line. Fourth, if all conditions are met, place a sell order at the break and close of the low of the second candle within the dark cloud cover. Ensure this sell order is executed within a maximum of 3 bars following the completion of the dark cloud cover. Fifth, set your stop loss above the high of the second bar of the dark cloud cover formation to limit potential losses. The piercing line pattern. The piercing line pattern, also known as the piercing pattern, is a candlestick pattern used in technical analysis to signal a potential reversal in the market direction, particularly indicating a shift towards an upward movement. This pattern typically emerges at the end of a downtrend, suggesting a possible change in momentum from bearish to bullish. Here are the 5 criteria for the piercing pattern. First, there must be a downtrend. Second, a bearish candle appears during that downtrend. Third, the next day, there's a gap down. Fourth, this gap down changes into a bullish candle. Fifth, the bullish candle closes above the midpoint of the previous bearish candle. Here is an examples of the piercing line trading strategy. Now, let's talk about the rules for a long trade using the Bollinger Bands indicator. We usually look at the daily chart for this strategy. First, we need to see a clear downtrend on the price chart. Second, we also need to see a piercing pattern happening. Third, the second bar in the piercing pattern should be below the lower Bollinger Band line. Fourth, when these conditions are met, we can place a buy order when the second candle in the piercing pattern closes higher than the first one. Make sure to do this within 3 bars after the piercing pattern finishes. Fifth, to stay safe, set a stop loss below the low of the second candle in the piercing pattern. Third, 3-line strike. How to trade the 3-line strike candlestick pattern. What is a 3-line strike pattern? This is called a continuation pattern, meaning the trend is likely to keep going, rather than changing direction. The 3-line strike pattern is one of these continuation patterns. Trading 3-line strike candlestick patterns. Bearish 3-line strike pattern. First, watch for first 3 bearish candlesticks to form. Second, next, watch for 4th large bullish candlestick to engulf first 3 bearish ones. Third, then, watch for 5th candlestick to break above 4th bullish one. Fourth, traders take a long position once the price breaks above the 4th candlestick. Fifth, place stop below the base of the 4th candle. Bullish 3-line strike pattern. First, watch for first 3 bullish candlesticks to form. Second, next, watch for 4th large bearish candlestick to engulf first 3 bullish ones. Third, then, watch for 5th candlestick to break below 4th bearish one. Fourth, traders take a short position once the price breaks below the 4th candlestick. Fifth, place stop above the base of the 4th candle. Second, bullish and bearish engulfing. Bullish and bearish engulfing patterns are considered some of the best patterns because they provide clear signals about potential changes in market direction. Bullish and bearish engulfing patterns are relatively easy to spot on price charts, even for novice traders. This simplicity makes them widely recognized and followed by many market participants, enhancing their effectiveness. First, bullish engulfing candlestick pattern. A bullish engulfing pattern is a special pattern on a chart that shows prices might go up. It happens when a candlestick that's going down is followed by a bigger candlestick that goes up and covers the smaller one. This pattern can be important because it means buyers are taking over from sellers and pushing the price up more strongly. This pattern is more reliable when the big up candle starts much lower than where the small down candle closed, and when the big up candle ends much higher than where the small down candle started. If the big up candle is a lot bigger than the small down one, it shows even more strength. How do we trade it? Before doing anything, traders usually wait for the second candle to finish, and then they decide what to do based on the next candle. They might buy if they see a bullish engulfing pattern, or they might enter into a long position. If they decide to buy, they might put a stop loss below the lowest point of the 2-bar pattern to manage their risk. Bearish engulfing candlestick pattern. A bearish engulfing pattern is a special pattern on a chart that suggests prices might go down. It happens when an up candlestick is followed by a bigger down candlestick that covers the smaller up candle. This pattern can be important because it means sellers are taking control from buyers and pushing the price down more strongly. This pattern is more reliable when the big down candle starts much higher than where the small up candle closed, and when the big down candle ends much lower than where the small up candle started. If the big down candle is a lot bigger than the small up one, it shows even more strength. How do we trade it? Before doing anything, traders usually wait for the second candle to finish, and then they decide what to do based on the next candle. They might sell if they see a bearish engulfing pattern, or they might enter into a short position. If they decide to sell, they might put a stop loss above the highest point of the 2-bar pattern to manage their risk. First, pin bar and inside bar combo patterns. To start our tutorial, I'll briefly talk about what pin bar and inside bar are. In simple terms, a pin bar is a candlestick pattern in trading characterized by a long tailor wick and a small body near one end of the candle. It shows rejection of certain price levels and suggests potential price reversals. This pin bar indicator is one of the best pin bar indicators that I've found, and the download link is on the description. If you are a new beginner trader, trying to identify candlestick patterns like reversal candlestick patterns and even pin bars can be difficult at first, so indicators like this pin bar detector or the candlestick pattern indicator are a really useful tools to use. How this pin bar indicator works: when you download the pin bar indicator and add it to your chart. If you use the provided template in the trading system folder, the pin bar indicator will appear on your chart like this. Pin bars can form anywhere on any chart, from the 1-minute time frame to the monthly chart, and if your trade entries are based on candlestick patterns, this indicator may be useful. Meanwhile, an inside bar is a candlestick pattern where the entire price range of a bar is within the price range of the preceding bar. It indicates a period of consolidation or indecision in the market, often signaling a potential upcoming breakout or change in trend. Best inside bar indicator. If you are looking for the best inside bar indicator, I got good news for you. You can download it here. The download link is on the description. Why trade inside bar patterns in the market? There's one main reason why Forex and stock traders use inside bar patterns to trade, and I will explain. Inside bars show a period of consolidation in the market. If you were to see an inside bar pattern on a daily chart, and if you were to switch to a smaller time frame like the 1 hour or the 30-minute chart to see what it would look like, you'd most likely see a triangle chart pattern. Inside bars tend to form after a strong price move, as price consolidates or pauses before making the next move in the same direction. Or on the other end, inside bars can also form on key support and resistance levels, and this can indicate that the market may be about to reverse or change direction. How the inside bar indicator works. This indicator shows you inside bars on your charts when they form. Does this indicator show inside bars in all time frames? Yes. From the monthly time frame down to the 1-minute time frame, this inside bar indicator shows you all the inside bars that form in any chart. On this chart, you can see how this indicator works. First, if an inside bar pattern forms and price breaks it to the downside, you will see a red rectangle. Second, if an inside bar pattern forms and price breaks it to the upside, you will see a blue rectangle. These two signals, when combined, result in either a pin bar combo pattern or an inside bar pin bar combo pattern. Pin bar and inside bar combination patterns are some of the most potent price action signals you will encounter. There are two main combo patterns you should focus on learning. First, the pin bar plus inside bar combo involves a pin bar that engulfs a small inside bar around the nose of the pin, or the pin bar's real body. Second, the inside pin bar combo setup is simply a pin bar that's also an inside bar. In other words, a pin bar that's within the range of an outside bar or mother bar. First, pin bar and inside bar combo trading. The pin bar and inside bar combination patterns represent some of the most powerful price signals you can ever imagine. These two patterns can send you to prosperity heaven, if you identify and trade them properly, of course. So, what is the pin bar and inside bar combination? The pin bar and inside bar combination forms when the pin bar is immediately followed by the inside bar. This phenomenon occurs towards the nose of the pin, or the pin bar's real body. At first glance, you'd think the pin bar is feasting on the inside bar in the manner it just towers over the inside bar. It's not humongous big, it's just that the tail, or wick, makes it look that way. It's almost as if it's walking on stilts. Now let's find out. How do we trade pin bar and inside bar combination? First, look out for the pin bar. Your point of reference is a candle with a long skinny wick pointing upwards. The pin bar must take shape near the nose of the inside bar. Once you identify the pin bar, you then look out for a smallish inside bar. If you're able to identify these two candles, you've got yourself a pin bar and inside bar combination setup. And when this setup takes shape, it's time to make your entry trade. Just make sure you make your entry trade along the support level. You then put your stop loss preferably below the pin bar. This graphic shows the formation of the pin bar and inside bar pattern at the line of support. See the way the market pulls back before the combination unfolds. Also, the multiple inside bars also signals the possibility of a decent profit. Next, here's another example of the pin bar and inside bar combo pattern. This time, it's more of a reversal pattern because it formed at a resistance level, causing a false break of that resistance level, and then set off a move to the downside. We can see a dramatic sell-off unfolded as price broke down below the inside bar. How to trade the inside pin bar combo pattern. Inside pin bars are exactly what their name suggests, pin bars that are also inside bars. These setups seem to work best in trending markets and on the daily chart time frames. In this example, we can see a strong uptrend was in place prior to the formation of the inside pin bar combo pattern. We can then see price broke out above the high of the mother bar, and this would have been the entry point into the trend. Traders can place a buy on stop entry just above the mother bar high on an inside pin bar combo setup like this one. Then as price breaks out in line with the trend, you are brought into the trade in line with the current market momentum. This chart shows us another example of a good inside pin bar combo pattern. This time, the trend was down or bearish, and as price consolidated for several days, it ended up forming the bearish inside pin bar sell signal that we see in the chart below. Inside pin bar combos work very good as continuation patterns in trending markets. A continuation pattern is simply a pattern that implies the trend will continue moving in its existing direction. Note the aggressive sell-off that took place once price broke down below this inside pin bar's mother bar. Pin bar and inside bar combo pattern trading tips. Always be on the lookout for pin bars followed by inside bars. Often, a one-day pause after a pin bar, in the form of an inside bar, will be your last chance to enter the market before price moves away aggressively from the pin bar reversal signal. Often, you can place your stop loss just above or below the inside bar in a pin bar plus inside bar combo setup. This gives you the ability to trade a slightly bigger position size and improves the risk-reward scenario of the trade. Look for inside pin bar combo setups in trending markets, especially in noticeably strong trends. They tend to be very reliable as breakout or trend continuation plays. Inside pin bar setups are best on the daily chart time frame, whereas pin bar plus inside bars work well on both the daily and 4-hour chart time frames. Now, you've gained a solid understanding of pin bar and inside bar combo pattern trading strategy. If you want to apply the exact setup demonstrated in this video, you can download all the templates and indicators from the description section below this video. I've included a template with the system that you can easily add to your chart, automatically plotting all these indicators accurately. This way, there's no need for any additional hassle. Find the download link in the description. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or X to show your support. See you next time.